Hello, everybody. Today with us, we are fortunate to have Mr. Mahesh Patil. He is the Chief Investment Officer of Aditya Birla Sun Life Asset Management Company. He is visiting our office and he is going to be the key resource in our interaction today. And this interaction would be moderated by me, myself, Daxesh Kothari, and Rajit Kothari, and we'll start with the interaction and we'll be covering so many topics of a lot of interest for the investors at large.
Very warm welcome, Mahesh.
Thank you for extending invitation here to be on this platform and interact with all your investors and your listeners. Yeah.
Thank you so much. So the past few months or past few years, in fact, have been extremely rewarding for all the investors. And now it's the markets crossing all-time highs day in and day out. Sensex crossing 82,000 levels, Nifty crossing 25,000. And the small caps and mid caps have literally multiplied over the years. So as much as it has been rewarding, it is also concerning now for the investors, especially when it comes to the fresh flows that they are planning to deploy in the market. What would be your take as far as the valuation of the markets are concerned, and what should be the perspective from an investor at this point?
Yeah, so I think you are right. I think the markets have seen a kind of a one-way rally, right? Post COVID, we can say that. I mean, it's been a kind of a one-way market with little or very low correction, you can say. And especially in the last one or couple of years, we've seen that certain pockets of the market have rallied even further, right? So, one thing is very clear that the market breadth has been the best what we have seen in many years. Whereas the market breadth means how many stocks which are doing better than the market, right? So, if you look at the BSE 500, and if you look at how many companies are doing better than the benchmark BSE 500, okay, that number is at almost like an all-time high. Which shows that the breadth has improved. There are many smaller companies which have done better. But again, if you look at the market again, the way to look at it is that one is the broader, which is a large cap. So if you look at in the last 5 years, because when you look at valuations, okay, and the returns of the market and the earnings growth, I think we have to look at it in that perspective. So in the last 5 years, because that's a good time to start, because it takes care of the COVID bottom, right? Otherwise, you would see a kind of a artificially higher growth. So in the last 5 years, the Nifty, if you look at it, the Nifty returns and the earnings growth of Nifty are more or less in sync. I mean, Nifty returns are slightly higher than the earnings growth. I think Nifty, if you look at it, that is slightly expensive than what it used to be below the before the pre-COVID level, right? On the other hand, if you look at the mid cap and small cap indices, right, the stocks over there, then where the return of the mid cap and small cap index is 50% of that is explained by the earnings growth, and 50% is because of the P-rating which has happened. So clearly, the mid cap and small cap segment has valuations there are significantly higher than what it is to be, say, around 5 years back. Say, in some cases, if you look at it, small cap, it will be almost like 50% higher than the average. So I think in that context, we might say that the small cap and mid caps, where the valuations are clearly running ahead of fundamentals. Again, not just looking at valuation standalone will not be always right, because valuations have also to be looked in terms of the outlook and the growth, right, which is there. So I think there is no doubt that the earnings growth trajectory, right, in the last few years has been much superior than what it used to be around, say, 5 years back, right? And that to some extent explains the market premium at this point in time. But I would say that valuations for the broader Nifty are only slightly higher than the long-term average. Again, one can also argue that the overall profitability of the corporate India has improved significantly than what used to be 5 years back. If you look at corporate profit to GDP ratio, that is also much higher than what it used to be 5 years back. The ROEs right? Return on equity of the companies are also much better. And also, when you talk about the index, right, when you normally we'll talk about valuation, look at the index because that's the most reference point. The index also, the companies, the structure of the index is slightly changed what it used to be 10 years back or 15 years back. Because when you look at averages, you look at over the last say, 15, 20 years, we have more of structural or non-cyclical companies being a larger component of the index than what used to be, like, say, 15 years back, which typically are slightly more expensive from a price earnings multiple compared to the cyclical companies. So on balance, I would say that the market is slightly ahead again, thanks to the large liquidity and money flow which is coming into the market. But within that, I think the small cap and mid caps appear to be slightly overvalued at this point in time, or I would say running ahead of the fundamentals. And that's where I think one would be slightly more worried because that's where the disappointment could come in if there is any kind of a negative surprise in the market.
Okay. So just in continuation of what Rajit was asking, which could be the sectors where you'd be more upbeat on, where you see that there is still an embedded value still in those the valuations which are commanded by the stocks of those sectors. So which could be those sectors according to you?
See, one is just looking at the sectors which are relatively kind of valuations are attractive compared to historical. But I think more importantly is to look at sectors where the outlook is looking good.
Okay.
Because just because something is cheap or relatively this thing could be also because for a reason. It could be that the outlook there is not so great, right? So it would not be the same. So I think it's more important to look at where the outlook is looking better and where the growth, earnings growth will be better, and that can support the valuations and can give you better returns, right, in relation to the broader market. So if you look at from that context, then I would say that it's like if you're positive on sectors like consumption, more so discretionary consumption, right? And why I'm saying that is because one is the sector in the last 1 year or has not done as well. Like post-COVID recovery, what we saw has consumption has lagged behind, especially discretionary consumption, because especially in rural India, right? And because of higher inflation, what we've seen, the disposable income has got impacted. So it's as a result, the stocks have underperformed. Only recently we have seen some traction looking in some of these consumer discretionary. When we talk about consumer discretionary, we talk about it, consumer durable sector, we talk about retail, apparel, right, quick service restaurants, all that, okay, would be part of that segment which we're talking about. And structurally, we believe that India is at an inflection point where per capita income is secularly moving up. We are at now $2,500 per capita, which we think will double, right, in the next, say, 5 years or so, that is 5 to 6 years. And that means that India's demographic center, the younger generation is the millennials are more aspirational. They're looking in for more premium growth, more branded products. And the urbanization which is happening will mean that the demand for discretionary goods, okay, will as a discretionary consumption, as a personal total consumption is going to increase. So that's a segment which structurally looks good, where you will see better growth relatively. Also in some of these sectors, there is a shift from unorganized to organized, okay, which will benefit the organized players. And as interest rates come down, and we think interest rates are peaker, I think you could see disposable income could increase. So that's a sector which we like it structurally, seen from a slightly medium to long-term perspective. Apart from that, sectors which, again, this is a time also where you want to be slightly more defensive. Right? We have seen a big rally in the cyclicals and some of these high growth sectors. So pharma is also a sector where we are overweight. Again, pharma is not only domestic pharma, it's export-related companies, also the healthcare sector, the hospitals and the diagnostic space. So that's a sector which looks to be reasonably good, where earnings growth is fairly stable. Pharma companies are actually doing well because the US generics markets, which was seeing some kind of pricing pressure, is seeing some moderation over there. So overall earnings growth is fairly decent.
Mhm.
And valuations are slightly expensive, but at least there is more stability there. So we like the pharma sector. Again, industrials are again capital goods sector is a sector which is slightly expensive. That's not cheap now,
Mhm.
right? But there are pockets where, right, especially in the power sector, where we see that the outlook there in terms of investments is going to be significantly higher than what we've seen in the last 5 to 10 years, both on renewables as well as on the traditional side. And that will be good for companies which are there, both in the power utility space, right? Where the valuations are, I mean, relatively still okay, I would say, right? So that's another sector which we are positive on. Apart from that, I would say in the financial services sector, the non-lending institution like say insurance
Mhm.
again is a sector which is again gone through some pain last year
Mhm.
because of some of the regulatory headwinds which we saw both in the budget which was there, so that and from the regulator also. Those are kind of likely behind,
Mhm.
and we see a steady growth in terms of penetration in the insurance sector as it increase. It's a sector which can see a reasonably good compounding at around say 15% or so. And valuations are also compared to historical levels are reasonable, I would say.
Mhm.
So I think there are some of the sectors where at least outlook wise, and we think they should do well, and we are overweight on these sectors in our funds.
And where would banks, private sector and public sector banks stand into this, order of, selection for
sure.
which sectors?
So the banking sector per se hasn't done as well last year. I mean, despite the fact that the sector recorded reasonably good. In fact, banks had the best in terms of their net interest margins because in a rising interest rate environment, banks tends to benefit more because your liability side cost doesn't go up same, right? Where your assets get repriced because of the now the lending rate is linked to the uh, benchmark rates, right?
Hmm.
And credit costs have been also very good. We are going to a very good credit cycle. But despite that, banks haven't done so banks relatively, if you ask a question, on a valuation basis, look fairly reasonable,
Mhm.
especially the private banks. Okay,
Mhm.
they have underperformed significantly. Even PSU banks have still done much better. I would say that private banks look relatively better at this point in time. Again, from a relative valuation perspective, historically what they were,
Mhm.
and also the fact that they would probably in an environment now where your asset quality would be slightly more important to look at, right? Because up till now we are in a very benign credit cycle and everything did well.
Mhm.
Even the banks which had poor underwriting did very well in this cycle. But as we see probably some kind of a stress from these levels going up, private banks will be better positioned to be able to do that.
Mhm.
So I would say that there the risk reward looks better. PSU banks are also doing well. Now the PSU banks have now kind of their balance sheets are in good shape. They probably had an advantage because of the good liability side, frankly, because now the biggest challenge is the liability, the deposit growth, right?
Mm.
So PSU banks are a little better in that sense.
Mm.
The loan to deposit ratio is also not that high. So they can probably still continue to grow. But if I take a longer term view, say next three-year view, then I would say the private banks can still continue to grow faster, gain market share. I mean, they're investing in technology. I think we should hold them, and the valuations are more reasonable, okay, compared to their historical levels. So probably with the three-year view, I would be more biased towards private banks here.
Yeah.
So moving further and shifting our perspective to the global arena, US Fed has now hinted that they would be reducing the rates, and the Fed chair has announced that the time has come now, and possibly this month it is expected they will reduce the rates further. And so, in that case, do you think that the Indian monetary policy, the RBI, will follow the narrative, especially at the current time when the banks are facing challenges in mobilizing the deposits further, vis-a-vis the flows that we are seeing in the capital markets? Because what will happen is that the real rates would then reduce if the narrative is followed. So at this point of time, do you think the real rates can reduce further?
So yeah, so one is I think it's becoming more clear that the Fed will reduce rates now because inflation is now kind of coming in the comfort zone, right? And US economy is also slowing down, right? It's seeing signs of slowing down. Labor market is cooling down. So I think we are expecting 3 rate cuts. The market is at least expecting 3 rate cuts in this calendar year. At the Fed. India, I think the picture is a bit different, slightly. Yeah, so while our inflation is also coming down, right? Core inflation is come down. And RBI is also now, while food inflation is slightly on that is also, if monsoons are good, it should be under control. So inflation is not a worry. So that should be at least comfortable for bank, I mean RBI to cut rates, right? That won't be a factor. But if you look at on the growth side, but we are still growing reasonably well. I mean, our GDP growth number, which came in last one around 7%, about 7%, right? So our growth is fairly steady. So there is no reason for stimulus from the rate cut side, right, to support growth. So I think in that scenario, I think RBI would probably not be so inclined to do it immediately. I think first US will cut rates. We'll watch and monitor that. And there is also no compulsion, right, for us. Okay, at the same time, we keep rates higher because we are fairly comfortable on the capital account side. But normally, if your current account, capital account is not that good, you'll keep interest because otherwise you see flight of capital, okay, which could be there. So I think on balance, I would say that RBI, at the moment, we don't think they will cut rate in a hurry. Our view is that they will do that probably at the end of this calendar year, somewhere the fag end of this calendar year. And in the interim, I think they will try to ease off the kind of a tightness which is there, right? So you will see liquidity easing. So liquidity was fairly tight until the elections, right? System-wide liquidity. Now that is being eased off, and we've seen the system liquidity is now getting into a surplus from deficit. So I think RBI will move trying to improve liquidity, okay, as a monetary tool to support, and rate cuts will probably be slightly later. But we will still see around 50 basis points rate cuts in the next same 9 months or so. But you said we'll see a larger rate cut because they also increase the rates much sharper, right? We have seen the fastest increase or the sharpest increase in the rates by the US in the last 20 or last 30 years, right? So clearly there the rate cuts will be much, the quantum will be much higher. In India, it will be much shallower rate cut cycle is what we see. And you also talked about the challenges of the deposit setup, which is there. So it will be much shallower rate cut cycle. Expect, and that too also with a lag to what US does.
And will it lead to maybe, say, as you said, that in US, the rate cuts would be sharper than what it could be in India? So will it lead to a meaningful increase in flow of capital to emerging economies like India, or it might not impact on account of valuations or something?
So I think there are various factors from global investors benefit that, right? So one is that rate cuts, so your dollar index, DXY will come under pressure, okay? The dollar will weaken. That is positive for global flows, right? When dollar weakens, at least flows into the emerging markets. And India being part of the emerging market should see some better inflows coming in. At the same time, also, there are relative dynamics which are there, right? For foreign investors to put money into India, they will look at how relatively India is looking attractive from a valuation perspective, from a growth perspective, of the other markets. Okay, because for a global investor, he can invest across the globe, right? So in that context, probably India is slightly expensive, probably for the right reasons, because the growth is also good, right?
Yeah.
You can't get everything cheap. Okay, when any stock which is good, you're also not very cheap. So they have been slightly worried about the India's valuations, relative valuation. That's why they have, even in the last 2 years, if you look at it, they have been net sellers, right, into the markets. But I think going forward, with interest rates cut and with dollar weakening, I think there'll be more probably money coming into emerging markets, so that's positive. And FIs have also sold quite a bit. I mean, their ownership in equity is now at the kind of a lowest level in the last 10 years. And they are overweight on India, right, which used to be there in the emerging market funds, which used to be around 3 to 4%, is now actually underweight. Right. So I don't think there is room for them to go down below. So I would expect that, yeah, I think it could possibly mean influence into emerging markets a bit and even into India. Okay, so you could see better. Obviously, if the market's correct, then you will see more buying coming in because I think long-term outlook for India is good and they want to participate because a lot of FIs, okay, they have missed the bus in a sense, right? So this time domestic investors have been able to really participate in this thing.
Yeah.
So they are willing to come in, okay, whenever they see a small correction in the market. So that could be a trigger for them to come in and enter into the markets.
One of the feeling or maybe a perception with the investors is that if the size of a particular fund scheme, mutual fund scheme, is smaller, then it would tend to deliver a better return rather than a scheme or a fund which has got a larger corpus, a larger amount of assets under management. So that is something which is on the minds of the investors. So what would be your take on that?
So it's not a very straightforward answer over here, but, okay. And there are various factors, okay, which get into, right, when you're looking at the fund performance. Size, okay, is one of the factors. Okay, size tends to matter more, right? Especially when you are dealing into, say, small illiquid stocks, right, where the impact cost could be slightly higher, right? When you try to on the portfolio or making some portfolio changes over there. Yeah, I mean, very simplistically, a smaller fund gives you a better maneuverability, okay, to manage that. But at the same time, also, we have seen that larger funds, right? Okay, when you're buying into larger funds, you tend to be much more diligent in terms of when you're buying a stock, you do a lot of due diligence because you can't, you can't flip that stock, right?
Okay.
So there's a lot of diligence you will, when you're introducing a new stock in the portfolio, which will go in. Also, larger funds have become larger because of certain track record and consistency of which is there, right? That's why the money is growing, right? So there is some reason why the buy the larger ones, right? So a smaller fund might show some performance in a short period of time, but again, might not have a track record on the credibility that it could be there. And we've seen that probably in this period, right, in the last 2 years, when the breadth of the market has been good, when risk has got rewarded disproportionately, a smaller fund would have been able to take that much better because it's easier to take a risk with a smaller fund because you know that you can probably unwind that. Okay. So that would have helped that, but that's not always the case. And typically, when you see that returns, okay, it will be higher because of higher risk one has taken. And when the risk unwinds, okay, when the market correction, I think you might see some of these funds also getting hurt because probably they have taken a higher risk. So the answer is not such a straightforward. We've seen larger funds also do well. And there are many smaller funds. If you go back and see corpus, there are many funds which are doing also not as well. Right. So a simplistic answer is it gives you some advantage, okay, but that's not the only multiple factors, okay, which go into right in the fund's delivery over there. So I mean, in hindsight, I would say that it is one of the factors, okay, as a fund manager, right? A smaller fund will give me some advantage, but there are multiple other things which, okay, are also equally important, which needs to be looked into when an investor is looking into deciding which fund to invest into and not necessarily just on the size.
So maybe in a shorter time frame, maybe the funds with a lesser amount of corpus might be able to behave in a different way. And maybe over a long period of time, it might be a different thing which might come up.
Yeah. And I see that some of the larger funds, because of their long track record, consistency, are probably much more stable. I mean, the volatility there, again, not necessarily, but will be slightly much lower, right? A smaller fund. So, kind of a bullish market, right? And this kind of this thing, a smaller fund would probably take the one better, right? And markets are not always that. We've seen markets are longer term, okay, it tends to invert or converge in that sense.
Similarly, another factor, a very important factor that most of the investors that we interact with look into while selecting or rather analyzing a fund is the past returns. And for so many of them, that is the only criteria while selecting or choosing a particular fund. What do you think would be the other factors, the other nuances, qualitative factors that they should be looking at while allocating and selecting a particular fund over and above the past performance?
Sure. So you're right, I think. And the past performance is not only in the fund, but anyway, even investors investing into a market also are biased or guided by their past returns, and they expect the same returns going forward, right?
Yeah.
And that's what's right, typical investor behavior, or conditioning, okay, which happens. And we all know, right? Over a cycle, returns tend to mean reward, to the long-term average in that sense. So when you're looking at past returns, again, it's important to look at what time frame you're looking at. Whether it's a 3-year, 1 year, 5 year, or a 10-year time frame. I think you should look at a slightly longer term. You should look at a fund across market cycle, right? To see in the good time or a bad time how it has behaved, right? So past returns are one of the factors, okay, we should be looking at. But besides that, also I think we should look at the track record for the fund manager, right? What is the track record in terms of how long he has been managing that fund? Because that gives you some kind of a stability to look at, right? The fund manager in terms of how he has done across a market cycle. So a fund manager who has had a long track record of managing that same fund, the vintage, I would say, no, is also an important factor, because then you can really analyze, okay, a fund across, because fund manager change while a fund house is also important. So that another level of filter, right? Okay, because fund performance is some kind of cyclical. We have seen that. But a fund associated with a fund house, okay, which has got the right processes, right, risk management framework which is in place, the right team and resources, will invariably tend to come back, even if the performance, okay, is not as great, right? So the tenure of the vintage of the fund manager who is managing it, the credibility of the fund house, okay, across various cycle. I think there are other factors, okay, which need to be looked at. And if you can do further drill down into the portfolio and look at what is the risk associated in that one, right? Because returns, what people tend to see only returns, but the risk taken to generate that returns is equally important to see. And there are various parameters in which you can do risk. I mean, there are certain risk-weighted returns which you can look at, or even the concentration risk, or risk in terms of what is the like, for example, in a flexi cap market, right? Larger the concentration of small cap or mid cap, even in higher. So it's done well in the last 3 years. But okay, when things mean the word, probably this can probably wind down a bit, right? The returns over there. So a risk associated, okay, with that fund for the drill down would also be important to look at, because when risk gets unwind, or like I said, last 3 years, higher risk has got rewarded. So you get a higher returns, right? But that same thing might not go to going forward. So that is also the risk adjusted returns is what we should be focusing on.
And lastly, say, insofar as the Indian stock markets and the Indian economy is concerned, today everything seems to be quite rosy and upbeat. But what can go wrong? What are the things which might stop this rally and stop this entire picture or thesis which is being built around the Indian stock market and the Indian economy?
Yeah, this is the question which everybody has, right? See, many times the risks, okay, which impacts the markets are the
Yeah.
There are the known risks which are there. Then there are known, unknown, and the unknown, okay, right? People look at it. But at least we can only talk about the risk which we think can happen, right? Known risk. So I think the larger risk can come from the, I think, global size, right? Because that's where there is much more uncertainty which is there. You see in the developed markets also rates have risen to unprecedented levels. We are now in a reversal cycle. Global growth has still been fairly good. It's actually surprised on the positive side. One has to see how that behaves, right? Going forward, okay, when you see a serious slowdown in global growth, okay, that can be a risk to global markets. And then also impact, because we are also linked, our economy is also linked to some extent. We are less dependent on global growth. So I think the slowdown in the US, especially in the US, low probability, okay, can be a risk, I would say.
Mhm.
Then there are this geopolitical risk. We have seen that there are a couple of years back. The Russian crisis. I think the risk perception has only gone up a bit. Right? What's happening in the Middle East and other areas. So any escalation of that can lead to instability, can lead to supply side shocks, and that could impact inflation, right? And can lead to correction in the global markets, kind of a risk off, and in turn impact our markets over there. You have US elections coming in, right? Very short term if you look at, right, in the next couple of months.
Mhm.
So that also depending on the policy, because whether you have Trump coming in, Biden, okay, what policies Trump has in terms of protectionism, I think that could also have an impact. On the domestic front, I think it has been fairly okay.
Mhm.
We've seen stable recovery which is there. I don't see inflation is also under control. But there is still some slowdown. I mean, look at it. While the headline numbers are looking good for the GDP, but underlying, we still see, for example, there's still things hanging because only that doesn't pick up. Especially season. So some of the assumptions what you're looking at could get impacted, and that could lead to some reaction into the market. More on the political side, you have the elections. So we see this on the market, the central elections, right, which was there, so the national elections, despite a wording which was not so what market was expecting, it did well. But I think if you look at some of the state elections, the large states which are coming in, right, in terms of how this coalition government is likely to survive, right, the results over there could be some reasons for the markets to, if the outcome is not so favorable, may lead to some kind of volatility. So there are some of the risks, which at least at this moment one sees, right? Which are the known risks. The unknown risk, anything can happen.
Yeah, true. Very much. A lot of insights on very important issues, and these are the issues which are basically the deciding issues for somebody to, put serious money and take a serious exposure into any kind of investments. So thank you so much. And special thanks for coming to our office and sparing your valuable time to address our clients and on the webinar. Thank you so much.
Thank you. Thank you. Thank you. Thank you, Mark.